Lending is changing every month, it seems like. There's new loans. There's new loans for CoLiving. There's new debt service coverage ratio loans. Which is a type of a loan that you can get where you don't even need tax returns and you don't even need income for these types of loans, which is pretty powerful, right? And there's all these different things. And so one of the keys to my success has been having lenders that are willing to get scrappy, having lenders that are willing to that are brokers. They aren't just working for one bank. They can shop multiple banks, right? That's one of the keys to my success. Lenders that are willing to go to their underwriters and talk about what I need for CoLiving, what I need to get deals done. You know, when I first started in CoLiving and even real estate in general, I 1,000,000% underestimated how important the banker was to my Avenger Squad team. Does that make sense? So I think if there's one thing you take away from this little episode, it's you need to be out there building relationships with lenders like it's your only job, right? And that doesn't necessarily mean you're beating them up for prices. It just means you're comparing them and you're maybe having them compete a little bit. Hey, can you do this? You can't do this? Well, this guy can do this. Look at the term sheet and here you go. And can you guys do better than that? And you're negotiating, guys, because if you don't, you're going to be left in the dark. One of my business mentors one time gave me the best phrase about business that I've ever heard. He said, Sam, business is resource war. And I remember thinking, whoa, okay, it was a little intense initially, but then I thought about it more and I thought, well, it kind of is resource war. You know, who determines who wins and loses in business or real estate? Well, the guy who's going to get the better loan, he's going to win. He's going to have more cash flow. He's going to be able to get more deals. He's going to put less money down. He's going to get better interest rates. If you want to win, the banker is key. So I'm doing this little interview with a guy named Trevor Higgins, who's one of my bankers that, you know, he's one of my secret weapons, I guess is what I want to say. And he recently just sponsored. I just took all of my inner circle students on a cruise, 4 days to the Bahamas. Beautiful, amazing. Brought my wife down there and our whole team. It was just really an amazing event. And we just got to hang out with everybody, talk real estate, have some massive breakthroughs in life. And this guy sponsored this trip. And he's one of our main bankers. And he's just going to bring some knowledge and some wisdom on the market today to you guys in this interview. So I hope you enjoy it. I'm going to just kick it off. Go check it out.
All right, ladies and gentlemen, we got Trevor Higgins in the house with Fairway Mortgage. Trevor, good to see you on, brother, and hope you're doing well.
Yeah, good to see you too. Thanks for having me, Sam.
Yeah, man, you got it. So, hey, real fast, the mortgage space is changing constantly. It's April 21st, 2025. What's top of mind for you when it comes to lending and someone trying to get a loan in the environment as it stands right now?
Yeah, I mean, lending is obviously constantly changing. So it comes down to it's really a puzzle, right? I mean, that's really what we do is figuring out your scenario, whatever that might look like, and finding a lending product that's going to meet your scenario. Especially with a lot of the stuff in the investor space, right? DSCR loans are great, but they're constantly changing. The guidelines are constantly updating. And one investor doesn't like the way you structure your LLC. The other one doesn't like rural properties. This one doesn't like, more than 7 bedrooms. So the landscape of lending is constantly evolving and something that's constantly changing based on the different investors' risk, right? I mean, that's really what it comes down to.
I love that you mentioned 7 bedrooms. We'll get to co-living here in a moment.
Yeah.
Obviously, that's something that you and I work together a lot on. You know, it's so funny. I can think of like 2 or 3 loans that I had with you where there was a point to where it was like, it almost looked like I might not get the loan. And you and your team kind of worked to this place where it was just like, no, Sam, we're going to find a way. We just might have to do this, or this. And we got scrappy, we got creative, we figured out how, because it was like the puzzle you're talking about. So what is the difference between what's the difference between a lender with that mindset and maybe someone who would have normally gotten to that point? And I remember me thinking like, oh, there's no way this loan's going to close. Like, I got to figure something else out. And then we got it and you closed it. What kind of mindset does that take from a lender side, from a broker or for a lender? Could you just explain like what's different about you that allows you to do that than maybe someone else that would just be like, no, sorry, can't close this loan?
Yeah, I mean, number one, it comes down to the team, right? So we have an amazing team from my business partner to our processing team, underwriting. We especially when we're able to do and facilitate a transaction that's in-house, it makes it easy. We can control it. It's a lot better because it's our underwriters. It's us doing everything. And so we have a lot more control to be able to work through those scenarios. And experience is obviously a huge piece of it, especially when you're working with self-employed clients, understanding and having a good grasp on taxes and how to navigate that, especially when you have a really complex scenario and you've got 350-page tax return. You having that experience to be able to navigate those things is extremely important. And then thirdly, I would say just options, right? I mean, Fairway, one of the reasons I stay here is we're constantly trying to evolve our product options and make sure that we're on the forefront of what's available, so that if there's a scenario that doesn't fit your traditional, conventional FHA, VA, whatever, we can find a scenario or situation in a product that's going to be able to fit that client's needs.
Could you just quickly define for people who are listening to this that may not know the difference? What is the difference? How would you describe the difference in 60 seconds or less between just conventional type lending and someone who wants a DSCR? And I know you operate in both categories, but just making that definition.
Non-traditional lending as a whole, so you have your conventional loan bucket. That's going to be the standard loan that you can go to any bank, any lender, Rocket, whatever, whoever you want to talk about, right? They can offer those traditional loans, and that's taking a look at the income that you have on taxes, or if you're W-2, that's pay stubs, and taking a look at the income that you're bringing in. Non-traditional lending products are going to look at things in a different way. So, for example, DSCR, or debt service coverage ratio loan, is just going to look at the cash flow on a specific property. They're not looking at personal income. They're not taking those things into consideration. But there's also bank statement loans, right? Let's say you're self-employed and you write off too much in expenses. So your net income is extremely low compared to what you actually bring in. You have non-traditional lending products that can look at your 1099 or can look at your business bank statements and derive those income figures versus utilizing the tax returns in a traditional manner.
So if someone's looking to buy a product like CoLiving, I know you and I have been building a partnership over helping our students get access to funding specifically for co-living homes. What is the best way for someone to, how do they need to look at lending and co-living? Maybe just speak on that briefly, because like it's not a one size fits all. Maybe this is some of the harder product. A lot of people come to me and be like, oh, like I even had someone recently that was like, you can't get lending for those. And I was like, well, you can. It may not be the easiest thing in
Yeah.
the world. How should someone be thinking about that?
Yeah, I think it comes down to the individual's capital ability, and what their ultimate goals are. But I think you don't box yourself out of any options on the acquisition or the refinance when you don't maximize so I like the phased approach in co-living, right? So phase one renovations, we're going to go to that 6, 7, maybe 8 bedrooms, nothing too crazy. We're not going to push the limits. We're going to refinance it. And then we'll go to phase two renovations to where we're going to add that 9, 10, 11, 12th bedroom, whatever that might look like. Because in the co-living space, one of the biggest limiting factors on the refinance side is the number of bedrooms. I mean, that wasn't something that was in any guidelines 24 months ago, and it's virtually in every guideline for DSCR lenders right now. So that's something you want to be cognizant of. And then just understanding DSCR loans as a whole, right? So if you look at short-term rentals and AirDNA, they were around for 3, 4, 5 years before DSCR products actually got on board and said, hey, guess what? We can use AirDNA now. We can do a short-term rental. We have enough data to back this up. So we're going to be able to create guidelines and lend around it. Well, co-living's so new that it's just not there yet. I think we'll get to a place where it becomes a lot easier, but we just haven't, there's not enough data that's available. Pad Split's probably the biggest company with access to the most data, in terms of co-living. So as more data is aggregated and as more information comes out, I 100% can say that there are going to be more lenders that open up to co-living. It's just going to take time. It just takes data.
Well, let's just say I'm someone who wants to buy my first co-living home. Where would you start with me where would you start with me as a client in terms of understanding if I can get qualified to buy my first co-living? Traditional or
Yeah, I
non-traditional?
mean,
Just like walk me through my option.
always start with traditional financing. It's always going to be the cheapest option as far as down payment goes. So your capital output is always going to be the least. Interest rates typically going to be better in the majority of cases. You don't have to worry about prepayment penalties and things like that on a lot of these non-traditional lending products that you have to navigate that space in as well. So that's always where we're going to start because it's typically, not always, but typically going to be the cheapest way to go.
So starting with conventional, and that would be
And
like
then obviously,
just a conventional investment loan.
yeah,
That could be
100%. Fannie,
15, that could
Freddie.
be 15, 20% down. I've heard you say that you have a product even that at conventional you can get, I think I asked you this the other day, you can get 15% down for someone
Yes,
at conventional,
100%
which
all
is
day. Yep.
crazy. That's powerful. Maybe a little higher interest rate, but a great. And then if that doesn't work, if my income can't qualify it for whatever reason, is that the moment I've got to go? Now, is there any other options? I guess that's pretty much your only option in conventional.
Yeah. Yeah.
Unless I'm willing to move into
Conventional
the
is
home. If I
conventional.
can move into the home, then I can use a primary if I'm willing to live in that for at least 1 year.
Yeah. Oh, house hacking is a phenomenal way to build your portfolio as far as the least amount of money out of pocket for sure.
And then
And
from
then
that standpoint, if that, yeah, take me from there.
yeah, yeah. I mean, and then if that doesn't work, it's going to be based on the scenario. You know, any loan from a non-traditional standpoint that's backed by your income, whether it's bank statement, 1099, P&L, whatever it is, you're going to have the ability to get to have lower down payment options. The biggest thing that we see on the DSCR side is any DSCR lender right now today is going to go and utilize long-term market rent to calculate that debt service coverage ratio. Well, when that DSCR ratio drops below a 1.0, 99% of DSCR lenders are going to require 25% down. And with rates the way they are and insurance costs continue to rise, property taxes aren't cheap, depending on what market you're in. The chances of that hitting a 1.0 with 20% down is probably not going to happen. We've seen it with a few short-term rentals, but nothing that's utilizing long-term rental income. And
Right.
so just understanding that fact is, you know, realistically, a DSCR loan is likely going to require 25% down in this market. There are very few markets across the country that have long-term rental income that's going to give you a 1.0 at 20% down.
What are some of the most, I just know you made a post recently in one of our communities. Like, what are some of the most creative products you've seen as you've added new lenders to you? And maybe I'd love for you to talk about that. I think there's a big misconception of like, what's the difference between a lender and a broker? And I'd love for you to
Yeah.
just chat about that for a moment so people understand why, as a broker, you kind of stand out. And then I'd love for you to understand I'd love for people to understand what are some of the most creative products. Like I think you were mentioning, or maybe I was talking with someone else about a no DSCR product. I think there's some
Yeah.
kind of, I don't know if
Yep.
that's something, or just there was a creative HELOC that I think you talked about recently on
Yep.
investment properties. Like I'd love for you to kind of share some of these super crazy things that I don't hear really anybody else talking about that you now have the ability to do for people, which I think is really powerful for them to understand.
Yeah, I mean the obvious goal, the first goal of ours is to try to do something that's in-house, right, with our underwriting. Why? Because versus a traditional broker route, you're going to avoid the broker fees. There's fees to broker a loan. That person that's doing it needs to get paid. Whereas if we can do that loan in-house, there's no fees. It's $12.95 flat. That's our origination fee. That's all you have.
Right.
That's all you got to do. But that being said, obviously, especially in the co-living space, a lot of stuff doesn't fit our in-house bucket. So we had to go out and find other lenders and other lending options. And that's where we've come up with several co-living and pad split friendly DSCR lenders, depending on how long of a history the house has been in service, being able to utilize the full income that you're creating with the co-living property. We've got that other lender you were just talking about where they pretty much do anything. You know, if the property's occupied, it's 75% LTV. If it's unoccupied, it's 70% LTV. Um, you know, the rate is all not super competitive, but they'll do rural. They'll do, you know, if you have 15 bedrooms in a single family home, guess what? They don't care. It doesn't matter. Um, they'll pretty much do anything when it comes to DSCR loans. So having that option available, especially if you're utilizing a hard money or some type of short-term financing on the front end for the acquisition, and you're in a position to where your property doesn't meet the guidelines that are out right now for any other DSCR loan, it'll get you out of that scenario so you don't have to be stuck in a bad situation. And then, yeah, we just rolled out a second closed loan second. So it's not a HELOC, it's a amortized, let's say 30-year fixed if that's the option you pick, but it's a second mortgage, so you don't affect your first mortgage. And it's actually utilizing the DSCR ratio, which will use lease income up to 115% of market rent. So
Wow.
because they're taking on a second lien position, they're limiting their risk on the cash flow side. So, if you have a lease that's $3,000 a month and market rent's $2,000 a month, they won't give you credit for quite the 3,000, but they'll give you credit for 115% of that market rent to allow that DSCR ratio to flow a little bit better.
And that's based on just like a market rent appraisal, even if it's, does it have to be occupied? Does it have to be occupied for that to happen or no?
Yeah, it does not have to be occupied. No.
Just do an appraisal and kind of go from there.
Yeah. So our big focus was just, we've talked to a lot of the members of the co-living community. We've talked to a lot of investors. It's probably the majority of what we're doing now from a lending space, and a lot of different similar scenarios kept coming up. And so it was really just about, hey, how can we find some lenders that are going to actually be able to service these clients where we're not having to jump through hoops and try to figure out, master leases and this and that and management companies, and like, can we just find some lenders that are say, hey, yeah, that's your membership agreement, that's your lease agreement, we like it, let's roll.
That's super cool. I mean, I have my last question for you is just like, what would you say are one or two of the most common misconceptions or misunderstandings that people have about what you do, or around getting financing in general, that you find yourself kind of like myths you find yourself busting a lot?
Yeah. No, that's a great question. I think the biggest one is, all lenders are created equal in the fact that, yes, another lender might have a conventional loan product, another lender might have a DSCR loan product, but do they really know it? Do they really understand it? Because we've seen so many clients start here or start over there, and they get, 2, 3, 4 weeks into the process. Oh, and this comes up. This lender doesn't allow for a 11-bedroom property, or this lender doesn't allow for whatever it might be. Oh, it's a rural area. Whatever that scenario might be. And those are questions that the loan officer should be asking on the front end, but you don't know what you don't know. And so
Right.
I think one of the most important things that I would stress, as if I'm an investor, which I am, is working with a lender that does investing and understands it, but more importantly, has a really good in-depth knowledge of what's going on, because these DSCR lenders, non-traditional lending products, they all have their own weird nuances. Like LLCs sound like something simple, right? I want to vest the property in an LLC. 99% of DSCR loans can vest a property in an LLC. Well, yes, but some DSCR lenders require every single person that's on that LLC to be on the loan. Some investors won't allow layered LLCs. So you have an LLC that owns another LLC, or a holding company and a management company. So there's a lot of different nuances that you learn and you explore, because, like I said, it's a puzzle. So we want to if this is what our puzzle looks like, we want to put that piece in the right place from the beginning, instead of playing jump around to different investors and see who's going to take whatever that scenario looks like.
Yeah. Wow. That's great. I love that you mentioned that. That's one of the things I like to preach to people too, is like, your lender, whoever you're using to get you your money, should be an investor. And I love that you are, because that puts you in a totally different ball. There's so many people that do investment loans, but that haven't invested or bought a single piece of property in their life, right? Other than maybe their primary home. And it's like, that's a different ballgame for sure. So that's awesome, man. Well, I want to just thank you publicly for how hard you work. And again, I said at the beginning of this call, this episode, that I've been the direct result of you working hard with your team, brainstorming, getting creative about, okay, how do we close a loan in this very unique situation? Or how do we close a loan with Sam, who has this many loans? And this is weird. That's a little off. Sam's self-employed, runs 2 businesses. And it's annoying. But I've seen you push incredibly hard to say, nope, we're getting this to the finish line. Just incredibly grateful for that. I know you don't just do that for me. I know that you're doing that for a lot of our students, and a lot of people out there that are trying to get financing on home in a, I don't know if you would agree with this, but in a time period that's not exactly like the easiest to get loans.
Yeah, right. No,
so yeah, man. So appreciate you being on. Thanks for sharing. Looking forward. If people want to connect with you or your team to get financing, what's the best way for them to do that?
Yeah, I mean, so you can find us on all social media platforms. Trev, Trev Mortgage is my handle on all social media platforms, or feel free to reach out. My direct line is 330-977-0017, and I'd be happy to have a call and see what we can do to help. Thank you guys. Thank you so much, Sam. It's always a pleasure working with you and the students, and I really appreciate everything you guys are doing. And honestly, as an investor, it's opened my eyes to I didn't even know about CoLiving until we met. And so what an amazing opportunity it is to help the community, provide affordable housing, but also be able to increase that cash flow and benefits as an investor. Absolutely amazing.
Well, you've been along for the journey. You've seen it kind of come together as it's expanded. Yeah. It is the number one way to achieve cash flow, I think. Not that it's the easiest way, but I think it's the number one way to get the highest cash flow in real estate right now that's consistent. And
absolutely would agree.
So yeah, man. Thanks for being on. God bless you. And we'll see you on the next show.
Perfect. Sounds great. Thank you so much for having me, Sam.
Wasn't that amazing? Isn't it good just to know how bankers think and how everyone is different? I could have had this exact same interview, asked the exact same questions with a completely different banker, and I would have gotten different answers. And why is that? I would have gotten different answers because all bankers are different. And I used to just think in my life, a lender is a lender is a lender is a lender. But how many of you know a lender is not a lender? They're not all the same. And Trevor is one of the really great ones. He's one of the most amazing ones, but maybe the best one, maybe one of the best ones for this space, right? Because he gets it and he understands it. So hopefully you enjoyed that interview. And please just give us a like or subscribe or share this video with someone that you think would help. And we'll be back more for tips on how you can expand your real estate and your co-living empire. Keep up the great work, guys.